Earlier on, I did told you about the news coming out from the aftermath of the Jackson Hole Symposium, in which the Fed chairman has hinted of a possible interest rate cut as early as the next FOMC meeting, which is supposed to take place between September 16 to 17. So he has highlighted two possible things to take note of. One is that the labor market in the US is obviously slowing down after the very sharp downward revision in the May and June numbers. And that is a concern because it also explains, or rather actually points to a slowing down in the US economy. And the other thing that he is mostly focused on is the impact of the tariff on inflation. And we can see that in the middle of August, we have the producer price index that comes in uh, uh, a lot hotter than expected. And for the month of June, the producer price index was at 2.6%. Okay, and the latest number for July is at 3.7. So that is 1 percentage point higher than the previous month, suggesting that inflation at the wholesale level is becoming very obvious. So in the months ahead, as the tariff policy become more embedded, we are likely to see more of the producer passing on the cost of tariff to the consumer. So this is where the Fed chairman is actually very concerned, because his dual mandate of maintaining stable prices right now is in jeopardy because of the rise in wholesale inflation. At the same time, he is facing headwind in the labor market, suggesting that he will have lower economic growth. So this will be the background going forward in the days and weeks ahead, and this will definitely impact how the dollar will be performing. This is the longer term outlook for the dollar index cash market going back all the way to the 1970s. We can see that the dollar has been relatively strong, moving up in a very narrow band seen in this channel here. So where the price of the dollar right now is sitting at the bottom of this channel here, does it suggest that it will bounce? Possibly. But now that we have a new element in place, with more certainty that the Fed is likely to cut interest rate, that will be a negative for the dollar, meaning to say that in a situation in which the Fed may be cutting interest rates going forward, then it will actually cause the dollar to come off. Okay, so between the two, I think now we know for a fact that the Federal Reserve is looking to cut interest rate. That will be seen to be a negative. So in the weekly time frame of the cash index, we can see that the dollar index having picked up in 2023 at 114.78 in a three-wave move here that we see in the chart here, and then 99.58 and a bounce back to 110.17 is likely to unfold in a classical three-wave pullback, targeting anywhere between 91.40 to 94, or rather 95. Okay, so this bracket of prices remains a very real possibility, technically speaking. So although we do see a bit of a bounce from the most recent low here at 96.38 all the way to 100.26, this could be seeing the resumption of the move towards the lower bracket of 95 to as low as 91 and a half. Okay, so this is based on the weekly time frame technical outlook here. So when I extrapolate it here, there is a very clear-cut ABC move here. So if it's an ABC move, which is a very classical corrective pattern, then an eventual move below 96.38 is almost a given. Okay, now that we know that interest rate cut is around the corner. Okay, so based on this, when we look into the futures contract for the dollar index futures traded out of the Intercontinental Exchange, or in short ICE, then we can see that the September contract for this product here is following this three-wave move in an ABC move. And for that, of course, the pricing will be very different, a little bit different from the cash index. We are looking at a move perhaps towards the 94.5 to as low as 91. Okay, so this remains a possibility, mimicking what we see in the cash index here. Now, this is the weekly time frame. The overall look and feel of it looks like an ABC to the downside, targeting at least 95. Here we have the daily time frame. You can see the dominant trend remains in favor of further losses in the dollar index. The swing higher is at 110. So we can see if this extend lower, there is a possibility we will see a move towards the 95, if not 91 to 94.5. And we can see that the move here from 96 to 100.06 is happening also in a very minor three-wave ABC move here. So that suggests that the corrective bound is over, and the moment the market take out 96 even, it is most likely going to be heading towards a 95 to as low as 91. So this is my outlook for the dollar index futures contract traded off ICE, and I hope it has been useful for you. And I shall see you in the next update. My name is Devin.